Very good morning, my dear soldiers. So we are in the chapter Amalgamation. In the last couple of lectures, we were done with the entire concept related to the amalgamation. So this is the time to proceed with problems. But as I already promised you, before directly proceeding with the problems, let me take a quick mind map or a revision map on the entire discussion what we had made till the date in the chapter Amalgamation. So please all of you concentrate at least for 10 minutes. So the entire thing just I want to consolidate in a quick mind map chart. So which is mind map related to amalgamation. So in this chapter, we started with the meaning of amalgamation, absorption, internal reconstruction. What exactly the meaning of amalgamation? Two or more companies liquidate and a new company is going to incorporate. Such process is typically known as amalgamation. Absorption. One existing company is going to taken over by another existing company, which is known as absorption. And we also seen external reconstruction. In case of external reconstruction, one existing company is ultimately taken over by another new company. But the objective in case of amalgamation and absorption is quite different from objective in case of external reconstruction. So in case of external reconstruction, entity want to show their financial statements at true and fair view position. That's why it is going to conduct or it is going to adopt external reconstruction. But in case of amalgamation and absorption, the objective is quite different. To get the taxation benefits, to get the synergy benefits, maybe to avoid the competition, maybe for any other objective, maybe for expansion into the new markets, etc., etc., etc. Okay. Then coming here, in case of amalgamation, so totally we are going to discuss three important concepts. One is purchase consideration related matters and accounting treatment in the books of selling company, accounting treatment in the books of purchasing company. So in PC calculation, AS14 plays vital role. And in the books of purchasing company, also accounting treatment is purely depending upon the type of amalgamation, which is clearly discussed in AS14. But in the books of the selling company, AS14 doesn't applicable. It doesn't have any significance. So simply closure of books of accounts. The related gap I should need to apply. Now, in case of PC, AS14 clearly defines that amount payable by purchasing company to the shareholders of the selling company alone should need to be treated as a PC. So here I told one slogan. What is that? To whom we are paying is relevant. What we are issuing or we are paying is irrelevant. Simply, you may issue equity shares, preference shares, debentures, cash, or any other asset. But if it is payable to the shareholders of the selling company, it will be form part of PC. Otherwise, you can simply ignore in computation of PC. We also seen in case of PC various methods like net payments method, net asset value method, intrinsic value method, lump sum method. In case of lump sum method, The PC is directly given in the problem, which is nothing but ad hoc consideration. In case of net payments method, how to calculate PC? Amount payable to need to check. So the summation you will get PC. In case of net asset value method, PC is nothing but the difference. You can treat it as a PC, which is equal to NAV as well. This is the PC computation under NAV method. In case of intrinsic value method, how to calculate PC, which is more or less is equal to the NAV. So here PC is equal to intrinsic value per share in selling company multiplied with number of equity shares in selling company. Now, one more important fact I discussed in case of the PC may be recorded at par value or the PC may be recorded at issue price. PC maybe this is PC recording. We can record it issue price or we may record it par value. One second, it is little bit hanged. Okay. If PC is recorded at issue price, then how to calculate PC? That is simply in above methods. Whichever method is suitable, that method I should need to apply. The same amount is automatically recorded at issue price. If it is clearly given that PC is recorded at par value, first you should need to work out number of shares issued as PC. Then you should multiply with the par value. Number of shares issued as PC is nothing but, so above method calculated PC. Above method calculates. Then if you multiply with the par value, then automatically PC will be recorded at par value. I told you one important or little bit complicated case. If the PC is under intrinsic value method and the PC is going to record at par value, at that time which formula we should need to use? Above method of PC in case of intrinsic value method, that is intrinsic value per share in selling company multiplied with number of equity shares in selling company. That is intrinsic value per share in selling company multiplied with number of equity shares in selling company divided by issue price means then purchasing company is going to issue at their own intrinsic value per share. Intrinsic value per share in purchasing company. If you multiply with par value, then which is PC is at intrinsic value method and recorded at the rate of par value. This point also I highlighted. And sir, which method is suitable for my problem? How I should need to identify? For that, I told you the flow we should need to adopt to identify the method of PC. After reading the information given in the problem, if you can able to ascertain amount payable to equity shareholders and preference shareholders, straight away you can consider the net. Some of the persons given the correct answer, some of the persons given the wrong answers. Later on you realized, right? So maybe something like that the information may be given. It seems like net payments method, but we are unable to ascertain amount payable to any of the shareholder. Then automatically the method of PC you should need to adopt it will be NAV method, right? In case of intrinsic value method, there will be no confusion. It will be directly provided in the problem itself clearly. Most of the times they are using the same terminology, intrinsic value. Lump sum method, no need to think, they will directly provide it. This is all about purchase consideration. Then we started our journey with selling company books. In selling company books, I discussed 5-step approach, if you remember. Separately opened. That means separate ledger you should need is we are going to sell such assets in the outside market. We are going to settle such liabilities by the liquidator itself. But we will start adjusting at later point of time. Just in step number 1, we should need to open separately. And the equity component, that is preference shareholders, preference share capital transferred to preference shareholders account. Equity share capital transfer to equity shareholders account. The reserves and surplus, whether it is negative or positive, you should need to make a transfer to equity shareholders account, including miscellaneous expenditure not written off. Miscellaneous expenditure not written off is form part of equity, which is represented under negative figure. Once the dismantling of balance sheet is over, then step number 2, PC due. So PC due entry is purchasing company account data to realization account at the rate of purchase consideration, because you should need to ask to the extent of PC amount from the selling company, sorry, from the purchasing company. That's why purchasing company account data, all your assets and liabilities should need to be transferred to selling, purchasing company. So, but right now all the assets and liabilities are sitting under realization account. So rather than crediting such assets, I'm directly crediting the realization account. That is objective behind passing this journal entry. Next, step number 3, PC receipt. Sir, in the form of PC, we may receive cash, we may receive equity shares of purchasing company, we may receive preference shares of purchasing company, we may receive debentures of purchasing company. Then you should need to cancel the purchasing company. Step number 4, once the PC received, you should need to distribute the PC, right? So the PC distribution, or before going to the PC distribution itself, the existing assets will be realized in the outside market. If any profit or loss on such realization, the liquidator should need to transfer that amount to realization account. Then distribution should need to happen in a particular order. That is, first liquidation expenses, then secured creditors, then unsecured creditors, then preference shareholders, finally equity shareholders. Till the settlement of this, any profit or loss simply again transfer to realization account. Sir, for settlement of liquidation expenses, I told you the separate entry. The entry is realization to cash. Actually, we see in chart. I'm going to explain the liquidation expenses adjustments in the mind map also at the end. Then step number 5, final settlement to equity shareholders. Before making final settlement to equity shareholders, close the realization account. Close the realization account. Find the profit or loss due to closure of your business. If it is profit, realization to equity shareholder. If it is loss, equity shareholders to realization. Do you agree? Then whatever the resources left over in the organization will ultimately settle down by the liquidator to the equity shareholders. If cash is left over, if equity shares of purchasing company left over, if you simply settle the equity shareholders with the existing resources, then equity shareholders account got closed and the existing resources account also got closed. Then all the ledgers will be automatically closed in the books of selling company. This is the 5-step approach we should need to follow in selling company books. Guys, don't be confused. Irrespective of type of amalgamation, irrespective of method of PC, there is no change in accounting treatment in the books of selling company. Now, if I come to accounting treatment in the books of purchasing company, it is depending upon type of amalgamation. If the amalgamation is in the nature of purchase, we should need to adopt the purchase method. If the amalgamation in the nature of merger, we should need to adopt the pooling of interest method. When an amalgamation is said to be amalgamation in the nature of merger, all the assets and liabilities should need to be transferred to purchasing company. All the assets and liabilities should need to be transferred at book values only. PC should need to be distributed in the form of fully paid up equity shares only. At least 90% share capital. Shareholders holding at least 90% share capital in the selling company would become the shareholders of the purchasing company by virtue of this amalgamation. And the same line of business should need to be continued by the purchasing company after takeover. If that is the case, the amalgamation is in the nature of merger. Otherwise, any condition it is not satisfied, then it will become amalgamation in the nature of purchase. Now, how to provide accounting treatment in the books of purchasing company under purchase method? First, let us check under our mind map. The first and foremost entry is business purchase entry, business purchase to liquidator of selling company. That is, if you purchase any good which is purchases to supplier, similarly here business purchase too, the amount should need to be payable to the liquidator of selling company. That's why I credited liquidator at the rate of purchase consideration. The business purchase means assets and liabilities we are purchasing. That's why you should need to incorporate assets. You should need to incorporate liabilities. At which value I should need to incorporate? At the rate of agreed value. Because at which value you are purchasing, at that particular value only you should need to incorporate. If you check which is also equal to NAV, now you should need to cancel the business purchase, because whenever you are incorporating assets and liabilities, the component of business purchase you should need to cancel. That is business purchase is at the rate of PC. That means indirectly you are comparing PC with NAV. Sir, in this case, if PC is greater than NAV, then which leads to goodwill. If the PC is less than NAV, which leads to capital reserve. It's very simple, no need to buy out anything. Whatever the amount we are paying is excess, but the benefit we are getting is less, then the excess payment over the benefit we can treat it as goodwill of the selling company. Whatever we are paying is less than the worth, whatever we are getting. That's why which is a capital profit situation and we are transferring to capital reserve. So that's why if it is the goodwill situation, you may incorporate here. If it is the capital reserve situation, you may incorporate here. Coming to the third entry, that is settlement to the liquidator. So at the time of making settlement to the liquidator, you should need to pass the following entry. That is, liquidator of selling company. If you are equity share capital, if you are issuing preference share capital to preference share capital, if you are issuing debentures to debentures, if you issue such shares at a premium to securities premium, if you issue such debentures at discount on issue of debentures, along with this, if you pay cash also to cash, that's it. And in case of pooling of interest method, the same entries you are going to pass except the second entry. Sir, how the merger is different from purchase method? In case of merger, purchasing company is going to take over all the assets as well as liabilities. Along with this, reserves and surplus of the selling company will also become reserves and surplus of the purchasing company. That's why at the time of comparison of PC with NAV, it can directly compare PC with share capital of the selling company, because there is no difference between share capital and NAV in case of the merger method. So if PC is greater than the share capital of the selling company, here goodwill we should not represent, because pooling of interest method we are treating the other company as my sister concern, just it is an extension to me. So I can treat it as a revenue profit situation or revenue loss situation. That's why whatever the excess PC I paid, I should need to adjust with the free reserves. I should need to adjust with the free reserves after takeover of reserves and surplus from selling company. So this point you should need to remember. No, sir, the other case, if the PC is less than NAV, then the case is same like capital reserve only. Except this, there is no difference between merger method and purchase method. In fact, if the problem is going to ask under merger method, from student side, it will be little bit easier. You know why? No need to think about agreed values. No need to think about all assets and liabilities were really considered or not. Do you understand? So such type of attention no need to provide at the time of resolving the problem. That's why it's always better to handle a problem under merger method while compared with purchase method. Okay, that is different story. If you come with the special items, I also discussed the special items, if you remember. Sir, in case of maintenance of statutory reserves, under purchase method, you should need to adopt one particular journal entry, that is amalgamation adjustment account at R2 statutory reserve account. If such number of years maintenance was over, then it is going to expire, then we should need to make it reverse the same entry. Till the date of reversal, amalgamation adjustment and statutory reserve, both we should need to show under reserves and surplus. But amalgamation adjustment you should need to show under negative figure, statutory reserve you should need to show under positive figure. Sir, but in case of merger method, no need to provide this adjustment entry, because in case of merger, all the reserves and surplus of selling company would become the reserves and surplus of the purchasing company. Automatically maintenance of statutory reserve is going to happen by virtue of amalgamation itself. Is it fine, guys? Next, one more special entry I told you, that is intercompany owings. Whenever intercompany owing situation is there in between purchasing company and selling company, you should need to pass the following entry, that is trade payable account data to trade receivable account. You should need to eliminate the respective liability as well as respective asset. If it is maybe related to bills payable, that is bills payable to bills receivable. If it is related to loan payable to loan receivable, something like that, you should need to eliminate the intercompany owings. We also discussed one more important aspect, which is nothing but stock reserve concept. Am I right, guys? Sir, whenever there is a stock in the books of the selling company, which was derived ultimately through purchase of goods from the purchasing company, then we should need to eliminate unrealized profit lying in such closing stock by passing the entry goodwill or stock reserve, sorry, goodwill or capital reserve to stock reserve is the entry. So the concept behind this entry, I clearly explained as on that time. As you know, this is the mind map. I'm not going to explain furthermore. Next, we also discussed the final issue related to the liquidation expenses, adjustment of liquidation expenses. Sir, if it is bared by the selling company and paid by the selling company itself, then the entry in the books of the selling company is realization to cash. Then at that time, purchasing company, no entry. Sir, initially paid by the selling company, but later on reimbursed by the purchasing company. Then in the books of the selling company, it should not treat it as their own expense. It will treat it as just a cash outlay, but later on I will get the same amount from the purchasing company. Once it will get that amount, bank to purchasing company. Then in the books of the purchasing company, what is the journal entry? So it was paid over and above the PC. That's why it debited the goodwill to cash, or it can debited the capital reserve as well, as the case may be. Now it was bared and paid by the purchasing company itself. Then in the books of selling company, no relevance, no entry. In the books of purchasing company, the same entry is going to pass. That is goodwill or capital reserve to cash. So this is the total summary what we discussed till the date, guys. Are you agree? Guys, are you comfortable? Uh, Guys, someone is telling sir video is buffering. Is that the case? Still, are you facing, guys? Just let me know. Varsha is asking, sir, in case of merger, how many years statutory reserve will be continue? No, it is not depending upon the type, ma. Which statutory reserve we are going to maintain will be the matter here. In the problem itself, they clearly tells us. For example, as per FEMA Act, we should need to maintain a foreign exchange translation reserve for 5 years, let us assume. If the selling company already maintained 2 years, the remaining 3 years should need to be maintained by the purchasing company. It all depending upon the type of the statutory reserve. No worries. For that matter, every information, everything will be provided in the problem itself. How many years you should need to maintain. Okay. Yeah, fine. Super. Guys, without any delay, without any further delay, now let me start directly with problem number 1. Sir, how I designed problem number 1, which covers calculation of PC, which covers accounting treatment in the books of selling company, which covers accounting treatment in the books of purchasing company as well. So I can tell this problem is like uh, a single problem which will try to cover all the concepts what we had discussed now. And one more thing, I unable to tell you each and every problem. It's too difficult in this short span. Okay. My plan is I will take some of the problems, but which will try to cover each and every concept. You should need to practice the remaining problems. But if you have good content and the concept and the practice, you can simply resolve the other problems as well. But the problems which I am considering for classroom discussion are pretty much will cover all the adjustments. Okay. This is my plan, how I'm going to cover from problematic side. Now, let me start with problem number 1, guys. All of you, please concentrate. Guys, this was I already uploaded in the material corner. So as I told you, so please you can download and put it as a PDF for you. Then you can able to resolve the other problems from your side. So Y Limited acquires the business of Z Limited. Y Limited is a purchasing company. Z Limited is a selling company, whose balance sheet as at 31st March 2011 is as under. Whose balance sheet means selling company balance sheet they are providing. Okay. So equity and liabilities, shareholders funds, share capital. Note number 1, it is given at 12 lakhs. If you come to note number 1, under 12 lakhs, equity share capital is 8 lakhs. Preference share capital is at 4 lakhs. Equity share capital face value 100. 6% preference share capital face value also 100. Next, reserves and surplus. Note number 2 given at 1,58,000. Capital reserve is there. Profit and loss account is there. Workman compensation reserve is there for 8,000. Expected liability is 5,000. So what is the meaning of this? They are indirectly telling that out of this 8,000, now at the time of considering the amalgamation, only 3,000 you should need to consider as reserve and surplus. The remaining 5,000 is liability. So if the organization is going to continue, then which is expected liability? If the organization ends, then there is no concept of expected liability. All the expected liabilities are going to be settled down right now. We are in the process of liquidation, right? Then the other person will ask such amount. So that's why the 5,000 will be the actual liability and the 3,000 will be the reserves and surplus. Okay. That means the actual reserves and surplus in the books of selling company will be 1 lakh plus 50,000 plus 3,000 only, which is 1,53,000 only. Remaining 5,000 you should need to make it treated as liability. Next, if you come to long-term borrowings under note number 3, which is given at 2 lakhs, 6% debentures are there at 2 lakhs. Further information, trade payable given, there is note number, there is no note number. Other current liabilities given at 12,000. Other current liabilities is nothing but interest payable on debentures. If you observe, debentures are 6% debentures. 2 lakhs into 6%, which leads to 12,000. Exactly 1 year interest is outstanding on the debentures. That was given under other current liabilities. Next, if you come to assets under non-current assets, property, plant and equipment, note number 4. Under note number 4, PPE, land and building is given, plant and machinery is there. Only 2 line items are there. Next, intangible assets exist. Under intangible assets, goodwill is there if you observe here. Goodwill is there, patents is there. Total 2 intangible assets exist. Next, inventories under current assets, trade receivable, cash and cash equivalents. Let me read the further information. Y Limited was to take over all assets except cash. Purchasing company is ready to take over all the assets except cash and liabilities. Liabilities means it will take over all the liabilities except for interest due on debentures, that is outstanding interest. That means purchasing company is ready to take over all assets and all liabilities, but except cash and outstanding interest. Guys, let me know. May I know the type of amalgamation here? Please, all of you participate at this moment. Type of amalgamation. Type of amalgamation. Still I am waiting. I'm not getting any answer in my chat box. Sir, still some of the people just I seen. Sir, video have problem. Can you please just anyone give some thumbnails or something like that? Is it my video is clear? My audio is clear? Still, are you facing any problem with the video? Okay, so hopefully you can able to see my video, right? Fine. Yeah, that type of amalgamation is amalgamation in the nature of purchase. You're absolutely correct. So because in case of amalgamation in the nature of merger, all the assets and liabilities should be need to be taken over by the purchasing company. But here some of the asset, that is cash, is not taken over, some of the liability outstanding interest is not taken over. That's why the amalgamation is amalgamation in the nature of purchase only. Correct. Next. Come to point number A. Rupees 2 lakhs face value, 7% debentures at the rate of 100 each in purchasing company for the existing debentures in selling company. For the purpose, each debenture of purchasing company is to be treated as worth 105. Sir, what is telling, sir? For the existing debentures of the selling company, for the existing debenture holders of the selling company, purchasing company is going to issue 2 lakhs face value of the 7% debentures. But the actual issue price is not at face value. The actual issue price is at 105. Simply, for the existing debentures of selling company, purchasing company is going to pay 2 lakhs into 105%. Simply. How much, which is 2 lakhs into 105%? 2 lakh. 10,000. Now my question is, amount payable to debenture holders of selling company, is it form part of PC or not? No, it is not form part of PC. Amount payable to shareholders of selling company alone treated as PC. Sir, then for which purpose this information was provided? Indirectly, he is conveying that agreed value of the debentures by the selling company is 2,10,000. Sir, to calculate the PC, or at least to know the NAV, we should need to know all the assets taken over at the rate of agreed value, all the liabilities taken over at the rate of agreed value, right? Then agreed value of the debentures, he is indirectly conveying that 2,10,000. It is not form part of PC. No doubt about it. Okay. For each preference share in selling company, rupees 10 rupees in cash and 9% preference share of 100 each in purchasing company. That means for preference shareholders, total, they are getting 10 rupees in the form of cash. So first I should need to check how many number of preference shares exist here. 4 lakhs divided by 100 means 4,000 preference shares. That is 4,000 into 10. Which is 40,000 in the form of cash, 40,000. In the form of preference shares, one preference share for every preference share in Z Limited. That is 4,000 preference shares into 100, which is equal to 4 lakhs. So total amount payable to preference shareholders will be 40,000 plus 4 lakhs, which is 4 lakh 40,000. If you come to point number C, for each equity share in Z Limited, 20 rupees in cash. How many number of equity shares exist in selling company? 8 lakhs divided by 100 means, which is 8,000 equity shares exist. That is 8,000 multiply with 20. 8,000 multiply with 20 means, which is equal to 1,60,000. In the form of cash, 1,60,000. And one equity share in Y Limited of 100 rupees each, having the market value of 140. I am going to issue equal number of equity share, but each and every equity share issue price will be 140. So how many number of equity share need to be issued? That is same 8,000 equity share need to be issued, but I should need to multiply with the issue price, because nowhere it is mentioned to record PC at par value. That's when number of shares issued into issue price, that is 140. This is the worth of equity share I am going to issue. So worth of equity share 8,000 into 140, which is 11,12,000. Now 1,60,000 plus 11,20,000 amount payable to equity shareholders how much? 12,80,000. Now let me know guys, amount payable to preference shareholders point B is 4,40,000. Amount payable to equity shareholders is 12,80,000. While after reading the information given in the problem, if you can able to ascertain amount payable to preference shareholders and equity shareholders, then the method of PC is net payments method. Method of PC is net payments method. May I know the amount of PC? 4,40,000 plus 12,80,000, which is equal to 17,20,000. This is the amount of PC. Next, still the problem is not yet over. Come to point number D. Expense of liquidation of Z Limited are to be reimbursed by Y Limited to the extent of 10,000. Actual expenses amounted to 12,500. Now, liquidation expenses total 12,500, out of which 2,500 bared and paid by the selling company itself. Remaining 10,000 first paid by the selling company, later on reimbursed by the purchasing company. That is the point indirectly he is conveying. Now, for this 2,500, what is the journal entry in the books of selling company? Bared and paid by the selling company means realization to cash for this 2,500. Then in the books of purchasing company for this 2,500, no entry. Then what about this 10,000? In the books of selling company, if it is initially paid by the selling company, it will record purchasing company to cash or bank. At the time of receiving later, bank or cash to purchasing company. Then in the books of purchasing company, what is the journal entry? Goodwill or capital reserve to cash, 10,000. So that means in the books of the selling company, at the time of adjusting the selling company, we should need to pass total 3 entries. Realization to cash 2,500, purchasing company to cash, cash to purchasing company. Or else if the impact is nil, if you feel something like that, no need to record this entry, the impact is nil. If you record this entry, that is more than enough. In the books of purchasing company for this 2,500, no entry, but for this 10,000, you should need to pass the entry goodwill or capital reserve to cash. That is the point you should need to remember. How you are going to apply while resolving the problem? Hope you are understanding. Next, Y Limited valued land and building at 5,50,000. For which purpose, sir, this is? This is agreed value for knowing NAV. Because in the books of purchasing company, while drafting the second entry, I should need to compare PC with NAV to know the goodwill or capital reserve, right? So if I want to work out the NAV, then I should need to assign the agreed values. If something different values are given, we should need to consider the different values. If nothing is given, the book value itself will be the agreed value. So land and building given at 5,50,000, plant and machinery is given at 6,50,000, and patents at 20,000 of Z Limited for the purpose of amalgamation. What are the requirements? I should need to calculate PC. I already done in the problem itself. PC I got 17,20,000 under net payments method. Provide the journal entries in the books of the vendor company and also provide the closing ledgers. In generally in exams, most of the times they will only ask to provide the ledgers in the books of the selling company. But as we are doing the first problem, just I told you to provide the journal entries as well. Provide journal entries in the books of the purchasing company. Most of the times in the books of purchasing company, they are asking to provide the journal entries only. And one more thing, after amalgamation, they are asked to provide balance sheet as well. But in this problem, I not included that. After completion of amalgamation, how the purchasing company balance sheet is going to look like. Also, they are going to test in the exams. So except this one, remaining 3, let's discuss in this problem. Guys, now let me know, are you people are comfortable in understanding the problem first of all? Yeah, fine. Guys, no doubt about it. Once my classes will be over, you may not have any further fear on the chapter amalgamation, because most of the students, they may feel like, sir, amalgamation is a typical chapter, sir. So amalgamation is very big chapter, sir. Amalgamation is lengthy chapter, sir. The adjustments will be complicated, sir. Even though we are having the good content or concept, there is no guarantee whether we can able to provide answers in the exams or not, sir. No, that was absolutely wrong. If you know the content or the concept, you may enjoy the chapter amalgamation like anything. You can simply provide the answers. The only difficulty for the student is in understanding the issues. If you're first having the good content, good grip on the concept, you can simply deal the problems at any cost. Okay, fine. Let me start working on my OneNote. So this is related to problem number 1. So in the working note, you can start anyway here in the first question they ask, even though if they are not at all asking in the first question, calculate the PC, still you should need to work out it on working note number 1. So just for your information, I am putting the working note number 1, but in this problem, working note number 1 is not required. That is the first sub question answer itself is PC. So in bracket, if you want, you can clearly mention net payments method. Sir, how I should need to represent, sir? How I should need to present the problem, sir? Actually, there is no presentation guided by AS14. That is in your own presentation, you can present for the PC. That is simply particulars, amount rupees. So you can start with amount payable to preference shareholders. So amount payable to preference shareholders in the form of cash, how much you are paying? Everything I was calculated already. Just I'm putting the same information here. That's it. Cash is 40,000. Just give a moment, guys. So that OneNote was closed. Mm, yeah, now it's working properly. Fine. So whatever I wrote, it didn't saved here. Okay, no issues. Just give a moment. I think due to huge data, sometimes my OneNote is not properly working. So after completion of this session, I'll do one thing. I'll remove the unnecessary pages. Otherwise, it will create a lot of problems for our future classes as well. Oh my God, finally I got it. So right, this is first one related to PC net payments method and particulars amount rupees. So I'm starting with preference shareholders payment in that cash. So cash was given at 40,000, right? Next, in the form of preference shares, I'm issuing the same equivalent number of preference shares, which is at 4 lakhs, right? Next, after preference shareholders, we should need to work out amount payable to equity shareholders. So amount payable to equity shareholders. Oh my God, again it's closed. I'm so sorry, guys. Please bear with me. uh, in the form of preference shareholders, just I work. Equity shareholders. Sir, in the form of cash, how much we paid, which is 1,60,000. We already worked it. So which is 1,60,000. And in the form of equity shares, how much? 11,20,000. So the total amount of PC, 17,20,000. So which is equal to 17,20,000, which is PC amount. So like this, you should need to make it present in the exams. Okay. So I'm in a little bit hurry. So that's why I'm not uh, writing each and everything in detailed manner. But in the examination, you should need to clearly present in this particular format. Then if I start with accounting treatment in the books of selling company, I should need to start with 5-step approach, guys. Am I right? So accounting treatment in the books of selling company, what I will do, I will not pass any journal entry. I'll directly start with the ledger. Even though in the problem they are asking to provide the journal entries, you know the journal entries. I already told you through the example. I will directly start with the ledgers. Okay. This is in the books of the selling company. So under step number 1, I should need to dismantle the balance sheet. Assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. For that purpose, I am opening a realization account. So this is realization account. Next, we should need to open the purchasing company as well, because in the second entry itself, purchasing company will be coming to the picture. That's why I will open purchasing company in bracket Y limited. Purchasing company here is Y limited only, right? This is purchasing company. Next, equity shareholders account I should need to open. Preference shareholders account I need to open, because if you check here, both the type of shareholders exist. So you can open equity as well as preference shareholders. Here, equity shareholders account. Here, preference shareholders account. So remaining based upon my requirement, I will open. For the time being, so these 4 accounts will be sufficient. If any further account is required, I will open at that moment. Now you can start with step number 1. All the assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization. That means accept this outstanding debentures and the cash. Accept this interest on outstanding debentures, outstanding interest on debentures, and this cash. Every asset and liability is taken over by the purchasing company. That's why you can simply make it transfer to realization account at book values. Let me know the asset side, guys. First of all, each and everything. Sir, I will directly record the PPE. I don't want to provide the individual balances. So realization to PPE. The PPE were entirely taken over, which is at 10 lakhs. Next, intangible assets also taken over. To intangible assets, 2,90,000. Next, the other assets, inventories taken over. Inventory, 1,50,000. Trade receivable taken over, 1,80,000. Next, cash and cash equivalent is not taken over. If any particular asset is not taken over, I should need to open it separately, right? So let me open cash and cash equivalent separately then. Cash account, just I'm opening separately. Cash to balance brought down, how much, which is not taken over, which is given at 70,000. So all assets over. If you come to liabilities, all liabilities taken over except this outstanding interest. So that's why liabilities only we have 2 long-term borrowings and trade payables. So by long-term borrowings, 2 lakhs. By trade receivables, by trade payables, sorry, trade payables 1,20,000. Fine. Guys, no need to confuse. Whenever you are in the books of selling company, always you should need to make it transfer assets and liabilities at book values only, because your intention is you want to close that specific account and make it transfer to realization. Okay. Agreed value concept doesn't come into the picture in the books of selling company. Now, this liability is not taken over by the purchasing company. That's why I will separately open with the name of outstanding interest. That is 12,000, right? So let me open here outstanding interest. So outstanding interest, which is at 12,000, by balance brought down. Simple. I am following step number 1, dismantling of balance sheet only. Assets and liabilities taken over, transferred to realization at book value. Not taken over, separately open. Next, if you come to equity share capital, transferred to equity shareholders account. Preference share capital need to transfer to preference shareholders account. That's why in preference shareholders, by preference share capital, 4 lakhs. In equity shareholders, by equity share capital, 8 lakhs. Correct? Next, under check the reserves and surplus, 1,58,000 reserves and surplus is there. If you come down, capital reserve is there, P&L account is there, workman compensation reserve is there. Out of workman compensation reserve, 3,000 is only the pure reserve, remaining 5,000 will be the liability. That's why reserves and surplus need to be transferred to equity shareholders is 1 lakh plus 50,000 plus 3,000, total 1,53,000 only. Actually, individual balances you should need to make it transfer. To save my time, just I'm transferring by reserves and surplus, which is 1,53,000. Okay. Sir, what about this 5,000 liability? If nothing was mentioned except outstanding interest, every liability is taken over by the purchasing company. Na? That means this liability, this 5,000 liability is also taken over by whom? Purchasing company. How you know such facts, sir? It is clearly given here. Na? All the assets, all the liabilities taken over except cash and except outstanding interest. That means this 5,000 liability is also taken over by whom? Purchasing company. If any liability is taken over by the purchasing company, I should need to close and transfer to realization. So that's why by workman compensation liability, 5,000 you should need to transfer to realization. Workman compensation reserve, 3,000 you should need to make it transfer to equity shareholders. In this 1,53,000, already 3,000 included. Is it okay to all of you? Now disbanding of balance sheet is over. Step number 1. Step number 2, PC due. What is the journal entry? Purchasing company to realization. Purchasing company to realization. Here purchasing company Y Limited to realization. At how much amount, sir? PC. PC I know 17,20,000. Second entry over. Third entry. PC receipt. What are the different forms you are receiving? Cash I am receiving for 2 lakhs. Cash account at are 2 lakhs. Preference shares of purchasing company 4 lakhs. Equity shares of purchasing company 11,20,000. To purchasing company is the entry. So then, 1 second, guys. At the time of passing the second entry, simultaneous posting I not given. In purchasing company to realization, in realization by purchasing company. Don't forget to give the simultaneous posting. Otherwise, your ledgers may not tally. So, okay. Now in third entry at the time of receipt of PC, entry cash, preference shares of purchasing company, equity shares of purchasing company to purchasing company. That's why in purchasing company by cash account 2 lakhs, by preference shares of purchasing company 4 lakhs, by equity shares of purchasing company 11,20,000. Is it correct? So above itself, the computation is there. If you want, you can cross verify. Cash 40 plus 1,60,000, 2 lakhs. Preference shares of purchasing company 4 lakhs. Equity shares of purchasing company 11,20,000. Actually, no need to open preference shares of purchasing company, equity shares of purchasing company separately. At the time of providing example for your understanding, just I open. Otherwise, so many ledgers will be there. The problem will be complicated much and your time will be wasted in the exams. Just in your mindset. So preference shares of purchasing company is also there as a separate ledger. Equity shares of purchasing company is also there as a separate ledger. Anyway, cash I have. That's why cash I will record it as to purchasing company 2 lakhs. Just you can assume these accounts were already open, but no need to open any preference shares of purchasing company, equity shares of purchasing company separately and physically. Okay. Now, sir, I received the PC, sir. That was also over. What is the next step, sir? Then if any particular asset which is not taken over by the purchasing company, I should need to realize in the outside market. Except cash, every asset was taken over. Cash was already realized asset, no need to realize in the outside market. Then start with liabilities. Start with liabilities means there is a particular order. First, in the order, I should need to start with liquidation expenses. So liquidation expenses related, everything we discussed, the same accounting treatment let me provide here. What is the accounting treatment? For this 2500 in the books of selling company, I should need to pass the entry realization to cash. For the remaining 10,000, if I pass the entry purchasing company to the cash, again I should need to book cash to purchasing company. So nullify with each other. No need to give impact for this 10,000 in the books of selling company. You can just give impact for this 2500. What is the entry? Realization to cash. So under realization, you can book to cash 2500 in bracket liquidation expenses. In realization to cash, then in cash by realization 2500. Sir, after this, liquidation expenses over. Next in the order, liquidator will pay secured creditors. Sir, any secured creditor is there? There is only one liability, which is outstanding interest on debentures is there. If you consider whether it is secured or unsecured, it doesn't make any difference, because the only one and only liability which is not taken over by the purchasing company is outstanding interest. In the order, you can just settle down the amount to this outstanding interest. That is to cash 12,000. If nothing is given means at the same book value we are going to settle. In outstanding interest, this is to cash. Then in cash by outstanding interest. By outstanding interest 12,000. Okay. Next. In the order of making payment, who will be the next party? There is no other liability holder. That's why liquidator will goes to preference shareholders. Now it is clearly given that preference shareholders will get 40,000 in the form of cash, 4 lakhs in the form of preference shares. At the time of making settlement to preference shareholders, the general entry is preference shareholders to cash to preference shares of purchasing company. That's why in preference shareholders to cash 40,000 to preference shares of purchasing company. That is 4 lakhs. Sir, in preference shareholders, if it is to cash, in cash by preference shareholders 40,000. Sir, where are these preference shares of purchasing company? If you would open a separate account, then while making settlement of these preference shares of purchasing company to the preference shareholders, that account might be closed, but you not open separately. If you remember, I told you just assume it is in the air. Okay, that's why it's got settled. The account got closed. Preference shares of purchasing company account doesn't have any balance in your books right now. Is it okay? Fine. And one more thing you should need to check at this stage. Sir, book value of the preference shares here 4 lakhs, but you settled at 4,40,000, which is loss situation. Any profit or loss at the time of settlement of the various parties by the liquidator, you should need to make it transfer to realization account. That's why here the loss is 40,000. This you should need to make it transfer to realization. In preference shareholders, this is by realization. Then in realization to preference shareholders, right? In realization to preference shareholders, which is 40,000. So up to preference shareholder settlement is over, then I should need to make the final settlement to the equity shareholders. But before making final settlement to the equity shareholders, first you should need to close the realization account to know the realization profit or loss. Can you please all of you calculate and let me know the realization profit or loss in the chart box quickly? Guys, let me know. All of you please quickly. Balance I required, realization account balance. So this side total I am getting 20 lakhs 45,000. So debit side total, let me know. This side total I am getting 16 lakh 62,500. So the difference is 3 lakh 82,500. Is it my calculation or computation figure is correct or wrong? Can you please let me know? Three lakh 82,500 is the balance. Sir, in realization, whatever the profit or loss we derived due to closure of the business, we should need to make a transfer to equity shareholders account. In realization to equity shareholders, then in equity shareholders by realization, 3,82,500. Now, if you check the equity shareholders account, how much amount we require to settle to the equity shareholders account? If you just make it total of the credit, 8 lakhs plus 1,53,000 plus 3,82,500. I required 13,35,500 guys to settle the equity shareholders. To pay this 13,35,500, what are the resources available with the liquidator? Available with the liquidator, one is cash resource and the other one is equity shares of purchasing company. Cash, how much is available? You can have a look. Debit side 70,000 plus 2 lakhs minus credit side 2,500 minus 12,000 minus 40,000. I have 2,15,500. Cash balance I have 2,15,500. This 2,15,500 plus equity shares of purchasing company 11,20,000. 13,35,500. I have the existing resources. How much I should need to pay? 13,35,500. That means exactly matched. It should need to be matched. Then only all accounts will be closed. Then in equity shareholders, 2 cash, 2 equity shares of purchasing company. 2 equity shares of purchasing company 11,20,000 and the existing cash balance 2,15,500. Then equity shareholders account got closed. In cash account, you should need to give by equity shareholders account 2,15,500. With this cash account got closed. Sir, this equity shares of purchasing company I not yet opened separately. If I make it settle to equity shareholders, anyway, those will also be closed. Now, if you check, no ledger having any balance. All the ledgers were automatically closed. Any doubt till now? Just let me know, guys. Any doubt? Is it fine? Till in the books of selling company, are you people are comfortable? Let me know, guys. I didn't see any chart. The flow is okay, guys. Is it in little bit speedier manner? If you make it practice, you can also habituate this. But in the exams, just believe me, you should need to maintain minimum this speed. So for how many marks in generally they will allocate for the entire problems? 15 marks, right? So the total paper will be for 180 minutes. So 15 by 100, that is around 15 percentage of your 180 minutes. 180 into your 15 percentage, maximum you should need to allocate 25 to 27 minutes, right? So reading the problem and for all such stuff, it will take like 5 minutes. Maximum you should need to spend on writing to resolve the solution for that problem is 20 minutes. That is calculation of PC, accounting treatment in the books of selling company, accounting treatment in the books of purchasing company if they ask the balance sheet as well. Okay. So because definitely no doubt about it, at least you should need to take 5 minutes to read the problem in sufficient manner. Otherwise, in the hurry-burry, if you read the problem, then it will go into the different direction. Most of the student, what they will do, they may not provide or they may not allocate much time on reading the problem. But just believe me, if you can provide good time or if you allocate good time while reading the problem, most of the issues will be resolved. Okay. Fine. One of our student Brinda is asking, sir, 1,53,000 in equity shareholders account is from where? Reserves and surplus, ma. Reserves and surplus belongs to whom? Under step number one in dismantling of balance sheet. Reserves and surplus, how much balance is there? Capital reserve 1 lakh. Profit and loss account 50,000. Out of 80,000, 5,000 we are treating as a liability. Remaining 3,000 we are treating as a reserves and surplus. 1 lakh plus 50 plus 3,000. 1 lakh 53,000 is reserves and surplus and not provided the split. Okay. Brinda, I answered your question. Okay. Yeah, that's fine, guys. This is about accounting treatment in the books of selling company. So all of you, please let's assemble by 8:25 around. Okay, let's take a deep breath, and you can just complete your breakfast if you want in this 10 minutes as well. So let's assemble by 8:25, and we are just starting with accounting treatment in the books of purchasing company post break. Okay, bye guys. So before the break, we're done with accounting treatment in the books of selling company. So let's continue our discussion with accounting treatment in the books of purchasing company. So tell me, to decide accounting treatment in the books of purchasing company, is it method of amalgamation or type of amalgamation we should need to know or not required in the books of purchasing company? It's mandatory to know the type of amalgamation. So the type of amalgamation is amalgamation in the nature of purchase. We decided a type of amalgamation at at the time of reading the problem itself. Purchase. Then what is the method of accounting treatment, guys? Which is purchase method. The method of accounting treatment is purchase method. Now, all of you, please participate here. So, the first and foremost entry is related to business purchase. So, at the time of purchase, the journal entry is business purchase account data to liquidator of selling company. So, which is Z Limited. So, at which value we purchased this business at the rate of PC? We already calculated the PC under the first sub question, which is 17 lakh 20,000. 1 second, I forgot to open the query link. Just a second. Yeah. So some of the persons just they're asking, sir, this class is related for May 2024 also. Guys, as I already informed you, related to amalgamation and internal reconstruction, there are no much structural changes in the new syllabus. So the same syllabus just they continue. Just the change in the texture. Okay. Uh, but the main content and material is as it is. But the liquidation of companies chapter was removed as per the new syllabus. It was clarified by me at the inception of the session. So still some of the students are asking. So that's why just I clarified. Yeah, fine. So this is what about the first and primary entry, which related to business purchase. And if you come to the second entry, we should need to cancel the business purchase. We should need to incorporate the assets and liabilities, what we taken over. But here, one thing you should need to remember, all the assets and liabilities, we should need to incorporate at which value here? Book value or agreed value? Agreed value. We are in the books of purchasing company. At which value we purchased, for the same value, we should need to incorporate. Then if you observe the problem, some of the assets, they considered at different values than book value. First, you can incorporate such assets. So land and building purchased at 5,50,000. One second. So Land and building account debtor, which is at 5,50,000. Plant and machinery, 6,50,000. Patents, 20,000. So these three assets only, just he mentioned the agreed values if you observe. Remaining no other assets mentioned here. That means remaining all assets, remaining all liabilities, they are agreed at book values only, unless otherwise specifically mentioned at any agreed value. So now if I check the balance sheet quickly, under property, plant and equipment, I consider land and building, plant and machinery both at agreed values. Intangible assets, patents also I consider at agreed value. Goodwill, we should need to incorporate, right? If nothing is discussed here, then we are taken over the same goodwill at a book value only. That is the meaning, right? So just I'm recording here goodwill at book value. How much? 2,40,000. Next, what are all other assets I have after intangible assets? Inventory, 1,50,000. If nothing is given, so we can assume that it is taken over at book value only. Trade receivable, 1,80,000. So what about this cash and cash equivalent? Is it cash is taken over? Only assets taken over at the rate of agreed value should need to be incorporated. This item is not at all taken over. It is clearly mentioned in the problem itself. All the assets except cash. And if you come to liability side, so long-term borrowings, that is 6% debentures, we are taken over, but not at book value. It is clearly given in point number 1. So I told you at that moment itself, for every debenture, we are treating as a worth 105. We are going to issue total 2,000 debentures, which is 105, which is equal to 2,10,000. That's why agreed value of the debentures was 2,10,000. The two, we are going to issue 7% debentures in Y Limited. So that's why two liabilities, the first and foremost liability, 7% debentures in Y Limited. Okay, this is not your company. So sorry, 1 second. We are taking over which debentures? Selling company debentures, right? The 6% debentures of the selling company, we are taking over at 2,10,000. This 7% is in the purchasing company. 1 second. To 6% debentures in Z Limited, you should need to write. Which company debentures you are going to take in over? Selling company debentures. So to 6% debentures in selling company accounted. I'm recording. At which value? 2,10,000, right? The taken over value is at 2,10,000. So next, after this liability, what are all other liabilities we have? So please be remember, out of this 8,000, 5,000 will be the liability only. That liability is also taken over by the purchasing company. So to workman compensation liability, which is 5,000. Don't ignore that. Okay. Long-term borrowings over, workman compensation liability over. The balance sheet, let me check. Trade payables, nothing was mentioned, 1,20,000. To trade payable, 1,20,000. Next, outstanding interest payable on debentures, not taken over, right? So that's why all liabilities considered. I considered trade payable, I considered 6% debentures, under that workman compensation liability also I considered. So every liability was taken care. These are the assets taken over and the liabilities taken over. Am I right? Now I should need to cancel my business purchase. To business purchase at the rate of 17,20,000. Now all of you please observe concentrately here. So at this stage I should need to compare PC with NAV, right? My PC is at 17,20,000. Now NAV is how much? NAV means, so total of these assets minus Total of outside liabilities. Can you please anyone let me know NAV is how much? 5,50,000 plus 6,50,000 plus 20,000 plus 2,40,000 plus 1,50,000 plus 1,80,000 minus 2,10,000 minus 5,000 minus 1,20,000. So NAV I got 14,55,000. Now let me know, guys, is it PC greater than NAV or PC less than NAV? The situation. The situation is PC greater than NAV. If the PC is greater than NAV, so I'll represent the difference as goodwill. The difference how much? 17,20,000 minus 14,55,000, which is 2,65,000 is the goodwill. Do you agree, all of you? Sir, I already incorporated 2,40,000 worth of goodwill. Now excess of PC over NAV, again I am getting 2,65,000. That means total goodwill I should need to incorporate here how much? 2,65 plus 2,40,000. Because again I unable to write goodwill, right? I already incorporated the goodwill amount. Rather than incorporating once again the goodwill, what I should need to do? I should need to change this figure. But if you already gave the old figure, how you can able to change? I mean, you should need to cross and you should need to give the total 5,05,000. It will not be good, right? That's why what I am suggesting, please concentrate all of you this point. If selling company is already have some goodwill and the same goodwill is taken over by the purchasing company, don't incorporate here. It will be automatically incorporated while comparing PC with NAV. How it is possible, sir? Let us assume if you are not incorporating any goodwill. If you are not incorporating any goodwill, NAV will be how much? NAV will be 14,55,000 minus, if that goodwill is not there, minus 2,40,000 means then NAV will be 12,15,000. If there is no goodwill, then NAV will be 12,15,000. Then if you compare PC with the NAV, 17,20,000 minus 12,15,000, the difference itself will be the 5,05,000 only. The same I incorporated here. Nothing is great here, just it is a mathematical issue. If I incorporate the goodwill of the selling company itself, while comparing with PC with NAV, if you are generating again goodwill, then double time I should need to incorporate. So rather than doing that, the first time whatever the goodwill selling company we are taken over, I am not at all incorporating. Without incorporation of the goodwill which was acquired from the selling company, if you compare the PC with NAV, the difference you are getting the goodwill or capital reserve, in that automatically that goodwill portion will be incorporated. Due to making the double time count, you can just make it work out in a single time. Is it okay to all of you? Tell me, guys. Can you please confirm anyone? This point, hope you understand. This is not the conceptual thing, just a clerical issue. So goodwill, here I am getting 5,05,000. Okay. $3.05 lakh. What is the 3.05 lakh? Someone is telling 3.05. Someone is telling 2,65,000. Guys, is it my goodwill is correct or I made any calculation mistake here? Huh? Just give a moment. Because the various students giving various figures. Let me cross verify with my calculator. My computation is absolutely fine here. You are giving the wrong figures. Okay. So if I incorporate the goodwill of the selling company at first instance, which is 2,40,000, then I got the goodwill 2,65,000. If I ignore the selling company goodwill. At the time of comparison of PC with NAV, the selling company acquired goodwill as well as excess of PC over with NAV. Both will be clubbed and both will be coming to the picture as 5,05,000. Okay. It's fine, right? Can I continue, guys? So 1 second, please. Yeah, right, fine. Sir, next. If I come to third entry, sir, I should need to make settle liquidator of selling company, right? So liquidator of selling company, that is nothing but Z Limited. Account data to, I'm issuing equity shares. That's why equity share capital. I'm issuing preference shares, preference share capital as well. I'm issuing cash as well, to cash. If any equity or preference shares are issued at more than the face value, then you can credit securities premium as well. Now, how much amount I should need to pay? 17,20,000, which is PC. Tell me, guys, 17,20,000. Now, in the PC computation, it is clearly given. Cash is how much? 40 plus 1,60,000. Total cash is 2 lakhs. So you can give credit cash for 2 lakhs. Sir, equity share capital, how much credit should I need to give, sir? How you are getting 11,20,000? Actually, 8,000 equity shares, each one issued at 140. If you remember, 8,000 into 140, you are getting 11,20,000. If you want, I'll open the problem as well. I'll show you once again. So for each equity share, Z Limited 20 rupees in cash and one equity share in Y Limited 100 each, having the market value of 140. That means face value is 100, excess for face value is 40. So 8,000 into 100, which is 8 lakhs, will goes to the share capital. 8,000 into 40 will goes to the securities premium. Do you agree? So here it will be 8 lakhs and the securities premium 8,000 into 40. So which is equal to 3,20,000. So then what about preference share capital? Preference shares are issued at face value only, which is 4 lakhs. Can make it total, it should need to be equal to 17,20,000. 8 plus 4, 12. 12 plus 2, 14. 14 plus 3,20,000, 17,20,000. Like this, you should need to represent. Sir, still the entries are not yet over. Just hold for a second, because the 6% debentures in Z Limited, we are issuing our company debentures. If you observe here, 7% debentures in Y Limited. We are in the books of Y Limited. We should need to issue and we should need to cancel the 6% debentures in Z Limited. Now, what is the entry? If I cancel the 6% debentures, I should need to debit that. 6% debentures in selling company, that is Z Limited account data. At which value I acquired 2,10,000. For the same value, I should need to cancel. To right now, I am issuing 7% debentures. These are my company debentures. That's why 7% debentures account. Sir, 2 lakhs worth of face value only I am issuing. That's why I am recording as a debenture capital 2 lakhs. Excess over the face value, I should need to make it transfer to securities premium. To securities premium account 10,000. Like this, you should need to cancel the selling company debentures. You should need to issue your own company debentures itself. And still the entry part is not yet over. What is that? Sir, related to the liquidation expenses, out of this 12,500, 2,500 completely paid and paid by the selling company. But we promised to pay to the extent of 10,000. Whenever you promise to pay to the extent of 10,000, the entry is goodwill or capital reserve to cash or bank. For that, you should need to provide the liquidation expenses entry, that is goodwill account data, because in the second entry, I derived the goodwill. That's why I'm debited the goodwill only. So goodwill account data to cash account 10,000. This is nothing but Liquidation expense of the selling company incurred and paid by the purchasing company. There are no intercompany owings. No need to maintain any statutory reserve because nothing was mentioned. And there is no stock reserve concept also. Fine. Sir, for the same problem, if we ask you to present the balance sheet, you should need to present the balance sheet. Actually here, the new company, Y Limited or the purchasing company, information was not given. So that's why with that intention, I not prepared the balance sheet. If at all, before amalgamation, if we given the balance sheet of the Y Limited, okay, then for the existing assets and liabilities of the purchasing company, I should need to adjust all these line items. What are the entries I passed, I should need to adjust. So first entry, no need to adjust anything because business purchase debit, business purchase credit. Liquidator of selling company credit at the time of making payment, liquidator of selling company debit. That's where there is no impact. Land and building added to PPE. Plant and machinery added to PPE in the balance sheet. Patents added to intangible assets. Goodwill added to intangible assets. Inventory added to current assets. Trade receivable added to current assets. Next, 6% debentures in Z Limited cancelled. We issued own company debentures. That's why 7% debentures should need to be added. Added to non-current liabilities. Workman compensation liability. Yes. Added to if it is a current, current. If it is a non-current, non-current. Trade payable, current. Business purchase, not impacted. It was cancelled. Liquidator of selling company, cancelled. Equity share capital, added to the existing equity share capital. Preference share capital should need to be added to the existing preference share capital. So cash 2 lakhs outlay. You should need to check the total cash closing balance. Existing balance minus outlay, then you will get closing cash balance need to be shown in the balance sheet. Securities premium, this 3,20,000 plus 10,000. Total 3,30,000 you should need to show under reserves and surplus. Goodwill need to be raised for 10,000. This cash is also outlay at the time of deriving the closing cash balance. Like this, you should need to consider this impact while drafting the closing balance sheet after amalgamation. So this is a full-fledged problem related to amalgamation, guys. Now let me know before proceeding further, your people having any doubt. Let me check. Is it fine? Everything is clear? If everything is clear, then I can move on to the next problem. If you are having any doubts, I'm very much happy to resolve your doubts. Please let me know, guys. No doubts? Please confirm, yeah. If you are having doubts, no doubt. Sir, explain the fourth entry, please. This entry now, fourth entry. This entry you're asking, right? Sir, fourth entry is really not the adjustment entry. Fourth entry is, if you check, we are acquired the debentures of the selling company, right? Debentures of the selling company in the name of the selling company. But for these debentures, we are issuing our own company debentures. That's why we should need to cancel the selling company debentures and we should need to issue our own company debentures. So to cancel the selling company debentures should need to be debited. To issue our own company debentures, I should need to issue debenture capital. I should need to raise the debenture capital. The excess over the face value, I should need to transfer to the securities premium. Okay. That is one thing. Yeah, fine. No doubt, sir. You can continue. Super. Next. So let us check some problems which are based on calculation of PC. So because the problem may be asked either from AS14 or may be asked from the chapter amalgamation. If they tested, but there is no difference between AS14 and amalgamation chapter. But for the weightage of the marks, if they test question from AS14, it will be around for 5 marks for computation of PC. If they ask question from amalgamation, the weightage is 15 marks. There is no difference. The concept, we may not bifurcate at the time of preparation, also no need to bifurcate. Okay. So let's do some problems based on the calculation of PC quickly at this moment. All of you please come to problem number 2. S Limited is absorbed by P Limited. That means P Limited is a purchasing company, S Limited is a selling company. The draft balance sheet of S Limited is as under. That means selling company balance sheet is given. So sundry assets given, share capital, preference share capital is at 2 lakhs, 7% preference share capital, face value 100. Equity share capital was given, face value at 100, 5 lakhs. Reserves given, 6% debentures is there, trade payables is there. P Limited has agreed, purchasing company agreed to issue 9% preference shares of 100 each in the ratio of 3 shares of P Limited for 4 preference shares in S Limited. For every 4 shares in selling company, purchasing company is ready to issue 3 shares. Am I right? Now let me know first of all, in the books of selling company, how many preference shares are there? 2 lakhs divided by 100 means 2000 preference shares are there. 2000 into, for every 4 preference shares, 3 shares I am giving means 3 by 4. For every 1 share, 0.75 share is going to given. For 2000 shares, how many number of shares I am going to issue? 2000 into 3 by 4. Correct? Still, if you have any confusion, sir, for every 4 shares, 3 shares means existing selling company shares 2000. Then you can cross multiply 2000 into 3 by 4 will come into the picture. Into each share is going to issue at 100. This is amount payable to preference shareholders. 2000 into 3 by 4 into 100, which is equal to 1,50,000. Correct? Next, to issue to the debenture holders, in S Limited, 8% mortgage debentures. Sir, debenture holders of the selling company. It's not form part of PC. No need to think, because the ultimate requirement is calculation of purchase consideration. Amount payable to shareholders of selling company alone treated as PC. No need to read or time waste. Okay. Come to point number 3. To pay 20 rupees per share in cash and to issue 6 equity shares of 100 rupees each, market value of rupees 125 in lieu of every 5 shares held in S Limited. First, in the form of cash, 20 rupees per share in cash means how many number of equity shares are there? 5000 equity shares are there. 5000 into 20. So which is equal to 1 lakh. Next, issue 6 equity shares each in lieu of every 5 shares held in S Limited. That means every 5 shares in selling company, purchasing company is going to issue 6 shares. So in the form of equity shares, now selling company is having actually 5000 equity shares. For every 5 shares, 6 shares they are going to issue means 6 by 5. If you want, you can put here 5000 shares. How many shares? Cross multiply 5000 into 6 by 5 into each share issue price. How much? For 100 rupees share, we are going to issue at the rate of market value 125 into 125. So 5000 into 6 by 5 into 125, which is equal to 7,50,000. Now you can calculate total PC, guys. Amount payable to preference shareholders 1,50,000. Amount payable to equity shareholders 7,50,000 plus 1 lakh, that is 8,50,000. 8,50,000 plus 1,50,000, 10 lakhs. Amount of PC is 10 lakhs. Sir, method of PC, net payments method. We can able to ascertain, right? Net payments method. There's no need to worry. Everything was clearly given in my PDF, written PDF, but I not it updated, I know. Okay. I clearly worked out everything if you want. Okay. So once the chapter got completed, I'll upload. Is it fine? Problem number 2, is it fine? Just let me know if you are having any doubt. So in between the problem, I can give the time like 1 minute. You can revise the content as well. You can check the content. If you are having any doubts, you can ask me. Okay. Can I move on to next problem? Right. So let me start with the next problem, which is problem number 3. So which is a standard problem actually. So it doesn't lose its place even though the syllabus got changed. So if you really remember, so primarily the CA Inter was so called as IPCC at that moment. At that time, this problem is there. Then after conversion of CA Inter, it have. Hopefully in the new syllabus also this problem is there. But the problem is not difficult, but the way of content so given it's a little bit different. Okay, that's why it has some significance. Fine. Neil Limited and Gagan Limited amalgamated to form a new company on 1/4/2015. Following is the draft balance sheet of Neil Limited and Gagan Limited as at 31st March 2015. So assets given, plant and machinery, building, current assets. If you come to liabilities, capital is there, current liabilities is there. Following are the additional information. The authorized capital of the new company will be 25 lakhs divided into 1 lakh equity shares of 25 each. Okay. So new company, that is amalgamated company, is having authorized share capital of 25 lakhs and 1 lakh equity shares, face value is 25 rupees. Indirectly, he is conveying that in case of purchase consideration, if you want to issue, you can able to issue each and every equity share at 25. That is the point he is mentioning. Liabilities of Neil Limited includes 50,000 due to Gagan Limited for the purchases made. Gagan Limited made a profit of 20% on sale to Neil Limited. If I would pass the accounting treatment in the books of purchasing company, both the special entries for both the two transactions, I should need to consider the special entries. But if you check here, my intention is not to provide the accounting treatment in the books of purchasing company. Computation of PC only I'm dealing. That's why, to be frankly speaking, these transactions doesn't have any significance for my requirement. No need to check about these transactions, unnecessary waste of times. But if they ask to provide accounting treatment in the books of purchasing company, then what I should need to do, sir? Then I should need to eliminate the intercompany owings. I should need to work out the stock reserve. But for the time being, you can ignore. Neil Limited has purchased goods costing 10,000 from Gagan Limited. All these goods are included in the current asset of Neil Limited as at 31st March 2015. Still, this point is related to computation of stock reserve only. You can ignore. Okay. Almost 1, 2, 3 point, no relevance for my PC. From these points, can I able to ascertain my PC? No, right? So let me read the further information. Then I will know really point number 1, 2, 3 are relevant or irrelevant for me. The assets of Neil Limited and Gagan Limited are to be revalued as under. Plant and machinery given, building is given. Okay. Revalued figures means something like that. He is indirectly conveying that these are the market values. At this market values, purchasing company is ready to take over. Okay. The purchase consideration is to be discharged as under. Issue 24,000 equity shares of rupees 25 each, fully paid up in proportion of their profitability in the preceding 2 years. Now, purchasing companies decided to issue 24,000 equity shares. But Neil Limited, how many equity shares are? Gagan Limited, how many equity shares are? According to their profitability ratio in the preceding 2 years. Okay, that means I should need to work out the profitability. Profits for the preceding 2 years were given. Neil 475, Gagan 525. That means the ratio is 475 is to 525. Can you make it a simplification? 475, 525, both will be divided by 25. We can able to divide 475 divided by 25. It will be 19, 21. That means 19 is to 21 is the profitability ratio. Simply this 24,000 I should need to distribute in this ratio means 24,000 into 19 by 40. 11,400 shares to Neil. Gagan, the balance, that is 24,000 minus 11,400. The balance will be 12,600. Okay. That is number of equity shares issued to Neil 11,400. Number of equity shares issued to Gagan 12,600. Each equity share value 25. This is okay. Next, issue 12% preference shares of rupees 10 each, fully paid up at a par to provide income equivalent to 8% return on net assets in the business as on 31st March 2015 after revaluation of assets of Neil Limited and Gagan Limited respectively. Sir, first, before going to calculation of PC, at this stage, just I want to ask one question. What is the method of PC? Just I'm awaiting for your answer. Please let me know quickly in the chat box, all of you. What is the method of PC? Sir, amount payable to equity shareholders. Issue so and so fully paid in proportion of their profitability. Given, if you check here, there is only given capital, Neil and Gagan Limited. They are telling that, sir, we are issuing equity shares. Here we are telling that they are issuing the preference shares. To Neil and Gagan, they are telling, but to whom they are issuing, nothing was given. If nothing was given, we can simply assume that they are giving to shareholders. I don't know, those are equity as well as preference. I should need to check only one thing, whether I can able to ascertain amount payable to shareholders or not. Yes, I can able to ascertain, but I should need to work something. If that is the case, then the method of PC is net payments method only. In the form of equity shares, how much I am going to pay, I already decided through point number B and C. Now in the form of preference shares, how much I should need to pay, I should need to work out through point number D. What is the given information? Issue 12% preference shares of 10 each, fully paid up at a par to provide income equivalent to 8% return on net assets. 8% return on net assets. I should need to issue some face value of the preference shares, income on such preference shares to the selling company preference shareholders should need to be equivalent to 8% on the net assets. Again, I'm reading. You should need to issue 12% preference shares. Sir, how much face value of preference shares you should need to issue? I don't know, sir. But if I issue such preference shares, on the face value of preference shares, preference shareholders of selling company will get income equivalent. Income means dividend. How much dividend they will get? 12% dividend, which is equivalent. Equivalent means equal to, which is equal to 8% return on net assets. Then you can calculate how much face value of preference shares you should need to issue. That means simply X is equal to 8% of net assets divided by 12%. If I know net assets of Neil Limited and Gagan Limited clearly, if I substitute the net assets, then the value of the preference shares need to be issued to Neil Limited and Gagan Limited. I can know simply, right? Can we work out the net assets? Then net assets you should need to consider after revaluation of assets of Neil Limited and Gagan Limited. Now, if I work out the net assets, please all of you come here. Net assets, plant and machinery. How much value I should need to consider? 5,25,000 I should need to consider, not this value for net assets, 5,25,000. Building, how much I should need to consider? 7,75,000. I should need to consider 7,75,000. Similarly, in Gagan, can you please check 675, 645? 675 and 645. These are the agreed values. Remaining all, if nothing was given, so the book value itself will be the agreed value. Plant and machinery, building, current assets, these three I should need to consider. And the liability portion, I should need to consider this part. Now let me know NAV, 5,25,000 plus 7,75,000 plus 1,63,500 minus 6,23,500. 8,40,000. For nail, it is 8,40,000. For Gagan, let me check. Gagan, 6,75,000 plus 6,45,000 plus 1,58,600 current assets minus current liabilities 5,57,600. I got 9,21,000. Is it correct, guys? Please, all of you confirm me. Is it the net assets, whatever I worked, is it correct? Right. Now let me check the face value of the preference shares issued to Neil as well as Gagan. 8,40,000 into 8% divided by 12%. For Neil, I got 5,60,000 here. For Gagan, 9,21,000 into 8% divided by 12%. Gagan, I got 6,14,000. Now, if you want to work out the purchase consideration, 11,400 into 25 rupees each equity share, that is 2,85,000. This is 2,85,000 plus this is 5,60,000. So for Gagan, the PC is 8,45,000. Sorry, Gagan or Neil? This is Neil. For Neil, the PC is 8,45,000. Sir, for Gagan, PC is how much, sir? This 12,600 equity shares, right? 12,600 into 25, which is equal to 3,15,000. The 3,15,000 in the form of equity shares plus in the form of preference shares 6,14,000. So total 9,29,000 is for Gagan I am getting. This is the amount of PC. Equity and preference shares issued to Neil and Gagan. Sir, how many number of equity shares issued? I already told you here itself. Equity shares, how many number of equity shares we should need to issue? 11,400, 12,600. How many number of preference shares we should need to issue? If you divide these figures with the face value, 10 rupees, that is 56,000 and 61,400 preference shares. Just if you divide the issue price, you will get the number of shares as well. This is all about problem number 3. Okay. 1 second. Yes, 1 second, please. Okay. Just I'm sharing, just I'm stopping my screen. Just give a moment, please. Yeah, guys, 1 second. So one thing here, just I think so. Net current assets. Can you please check this 9,21,000 is correct? Every calculation is correct here. Just now I cross verified once again. Just give a moment. This is 6,75,000 agreed value plus building agreed value is how much? This is 6,48,000. Yeah, that's a little bit. It's different. It is not 6,45,000. 6,48,000. 6,75,000 plus 6,48,000 plus 1,58,600 minus 5,57,600. 9,24,000. So 3,000 difference is there. 924. So if you can check 9,24,000 into 8% divided by 12%. 6,16,000. So 2,000 here difference. 6,16,000 plus 3,15,000. How much? 6,16,000 plus 3,15,000. 9,31,000, huh? Correct, huh? So this is in the form of equity shares 3,15,000 I got. In the form of preference shares, I am getting 6,16,000. So total 9,31,000. The 2,000 difference I am getting, that is only due to I'm while recording the figures from here to there, I missed out the 3,000. Okay, these figures will be finalized, guys. Let me check the doubts 1 second. Sir, in current assets, we have adjustment related to stock also. Harshit, you are a little bit confusing. Here, net assets means agreed value of assets and liabilities. That's it. Agreed value of assets and liabilities means whatever the assets and liabilities they are given, such assets I should need to consider. But definitely I should need to adjust the stock reserve. But the stock reserve I'm going to adjust not for the purpose of knowing the agreed value. Do you understand this point, all of you here? So that too, they are clearly telling that for the purpose of computation of PC, here you should need to work out the net assets. What they are given? 8% return on net assets in the business after revaluation of assets of Neil Limited and Gagan Limited respectively. According to the problem, just I am going. Make the revaluation of these assets. Consider the remaining assets and liabilities as it is as per the book value. I worked out like that. But if nothing was given, I should need to work out NAV, let us assume. Then that is different. At that moment, each and every asset and liability at which value I should need to agreed. I will check. At that moment, definitely I will calculate the stock reserve. I will adjust the stock reserve from the current assets. The net current assets only I will consider. But right now I should need to go along with the problem. They clearly given that only you can consider the revaluation impact. Don't consider any other impacts. Just you can consider as it is remaining assets and liabilities balances. Do you understand? That is all depending upon the terms and conditions given in the problem. But if nothing was given, clearly you should need to work out on the net asset value. Nothing was given. Then you should need to consider what are all different assets I am taking at agreed value. What are all the different liabilities I am taking at agreed value I will consider. Is it okay, Ma? Yeah. So any doubt for problem number 3? So let me cross verify the final figures with my, any computation clerical mistake. If I done, it may be identified. So 8,45,000 for Neil. We got the same, right? 8,45,000, 9,31,000 for Gagan, 9,31,000 for Gagan. Yes, it's absolutely fine. So this is all about problem number 3, guys. So shall we move on to problem number 4? In this session, let's try to complete the entire PC based problems. Then we can have good buffer time for tomorrow's session to discuss some problems related to exams, some problems related to mainstream. Okay. So let me start discussing problem number 4, guys. Sir, both the models are equally important. So number of times there is a high probability to ask a question from PC as well, because if at all they want to test a question, 15-mark question from either partnership accounts or either from consolidated financial statements or either from banking companies, at that moment they might have ignored the amalgamation. There may be a scope from asking problem from internal reconstruction as well. Okay. So if at all they tested problems from other than amalgamation for 15 marks, definitely you can expect problem based on the PC computation. It will be for 5 marks. Sometimes they may ignore the other chapters. 15 marks problem, if they test it from the amalgamation, they may not ask any problem for computation of PC. Sometimes double dhamaka will be there. Computation of PC problems will be there under compulsory question first for 5 marks. And the 15 marks will also be given. It's very rare situation. I seen a couple of question papers where both the type of problems are also tested. Okay, fine. Let me start with problem number 4. Let us consider the balance sheet of X Limited as of 31st March 2011. Share capital given, reserves and surplus is there, long-term borrowings is there, trade payables given. Under share capital, let us check notes to account. 7,50,000 equity shares of 10 rupees each. 25,000 14% preference shares of 100 rupees each. Rupees are in thousand, guys. Equity shares face value 10, preference shares face value 100. Under reserves and surplus, only one reserve is there, which is general reserve. Under long-term borrowings, 14% debentures are there. Okay. Next, further, if you check asset side, property, plant and equipment, note number 4, we should need to check. Non-current investment, note number 5, we should need to check. Remaining all are current assets, inventory, trade receivable, cash and cash equivalents. If you come down, property, plant and equipment, land and building is there, plant and machinery is there, furniture is there. Non-current investment at cost is there. Other information, Y Limited take over X Limited on 10th April 2011. Y Limited is purchasing company. X Limited is a selling company. Debenture holders of X Limited are discharged by Y Limited at a 10% premium by issuing 15% own debentures of Y Limited. First of all, what you require PC. If debenture holders of X Limited are discharged, amount payable to the debenture holders of the selling company is not form part of PC. I don't want to read anything. Furthermore, come to point number C. 14% preference shareholders of X Limited, that is 14% preference shareholders of selling company, are discharged at a premium of 20%. Discharged at a premium of 20% means for 100 rupees share, I will provide 120 because face value is 100. I will provide at the rate of 120. Okay. By issuing necessary number of 15% preference shares of purchasing company, face value 100. First, total how much amount required to settle the preference shareholders of the selling company? That is 25,000 into 120. I required 30 lakhs amount. Yes, I required 30 lakhs amount. To discharge this 30 lakhs amount, purchasing company is going to issue each and every 15% preference share at the rate of 100, right? At the rate of 100 means how many number of preference shares I should need to issue? 30,000 preference shares I should need to issue. 30,000 preference shares. Okay. So worth of preference share to be issued 30 lakhs. Number of preference share to be issued 30,000. That is point C meaning. Next, if you come to point number D, intrinsic value per share of X Limited is 20. First time we are come acrossing the intrinsic value method. Okay. Intrinsic value per share of X Limited is 20 rupees and that of Y Limited is 30 rupees. Y Limited will issue equity shares to satisfy the equity shareholders of X Limited on the basis of intrinsic value. However, the entry should be made at par value only. The nominal value of each equity share of Y Limited is 10 rupees. Compute PC. So the first and foremost question, what I'm asking, which method of PC this is? All of you please participate. PC is which method?
Still, I'm awaiting for your answers. Which method of PC it is? No one is talking here. No one is providing any answer. Please interact, all of you. While seeing the video lectures also, the students may feel bored if it is a little bit interaction. Intrinsic value method, sir. Intrinsic value method, sir. Sunil Kumar only told net payments method. Yes, this problem method of PC is net payments method. I need to check only one thing. Sir, from the given information, can you able to ascertain amount payable to preference shareholders? Yes, just now ascertain. From point number D, how much amount I should need to payable to equity shareholder? For that, I will apply intrinsic value method. But the overall PC is I can able to ascertain amount payable to preference shareholders. How can I can able to ascertain amount payable to equity shareholders? Then if I make it total, which is net payments method only. But part of the PC consideration, I should need to apply the intrinsic value method. In fact, this type of PC methods is combination of more than one method. The overall PC method is net payments, but out of the part of PC computation, I should need to apply the intrinsic value method. That's why which I can call it as combination of more than one method. Okay, right, fine. Let me put this problem into my OneNote for better understanding. Problem number 4, right? So don't worry, guys. With this problem, let's wind up this session. Okay. Then all PC related problems will be over. From the next session onwards, we are going to concentrate on the other issues. So right, problem number 4, PC is under net payments method. Now first, I should need to check amount payable to preference shareholders. First time recording. So I already decided it is clearly that is each and every preference share I'm discharging at 20%. Number of preference shares I'm issuing 30,000 preference shares. We worked out here, right? So you can clearly give the same thing 30,000. What is the percentage of preference shares issued by purchasing company? 30,000, 15% preference shares issued at the rate of 100 each. That will be how much, guys? 30,000 into 100. It will be 30 lakhs. This is amount payable to preference shareholders. Next, amount payable to equity shareholders. I not yet explained. Please concentrate. Intrinsic value per share of selling company or purchasing company, X Limited, selling company. Intrinsic value per share of selling company is 20. Intrinsic value per share of purchasing company is 30. Will issue equity shares to satisfy the equity shareholders of X Limited. Simply, he is telling that on the basis of intrinsic value, we are going to discharge the equity shareholders of the selling company. However, the entry should be made at par value only. If you really remember, PC intrinsic value method, PC is recorded at par value. Then how to calculate PC? Number of shares issued as PC multiply with the par value. How I need to work out the number of shares issued as a PC? Number of shares of issued as PC, how I will get? This I will get. PC first I should need to calculate in the normal procedure. How I am getting the PC in case of intrinsic value method? Intrinsic value per share in selling company multiplied with number of equity shares in selling company divided by, just a moment, divided by intrinsic value per share in purchasing company into par value. This is the formula I should need to apply. In today's session also, while discussing the mind map, I used the same formula if you remember. I'll show you if you want. Where is my mind map? Just give a moment. Yeah. Under PC, to record the PC at invoice, intrinsic value method and PC is recorded par value. The formula is intrinsic value per share in selling company multiplied with number of equity share in selling company divided by intrinsic value per share in purchasing company into par value. Now, if you check here, intrinsic value per share in selling company, how much guys? 20. Number of equity shares in selling company, how much guys? Here itself, they clearly given number of equity shares. 7,50,000 equity shares. Divided by intrinsic value per share in purchasing company, how much? Here it is given 30. Into issue price, how much? That is par value, not issue price. Par value, how much? 10 rupees. Now, can you please work out amount payable to equity shareholders, how much? 20 into 7,50,000 into 10 divided by 30. So I'm getting around 50 lakhs, which is 50 lakhs. Now, if I want to know the total amount of PC, so go to the main content. So amount payable to equity shareholders is 50 lakhs. So 30 plus 50, which is equal to 80 lakhs is the PC. How I got that 50 lakhs? By applying that formula. I'm not representing here, right? Okay. If you want, you can clearly write like this: 5 lakh equity shares at the rate of 10 rupees each. 5 lakh into 10, which is equal to 50 lakhs. This is what about problem number 4, guys. Is it fine, all of you? Is it fine, guys? So problem number 4 is also a little bit different problem. Please, you can put it as a star mark for problem number 4 and problem number 3 also. There may be a high probability to ask such type of problems in the exams. So with this, we successfully completed problem based on the PC and the basic problem which covers the accounting treatment in the books of selling company and purchasing company as well. Sir, in tomorrow's session, let's take some like 2 to 3 important problems, but which are big problems, where we are going to present the balance sheet after amalgamation as well. So out of 2 to 3 problems, or if time permits, I may take one more problem as well. So most of the problems, like definitely 2 problems will be considered from the past exams only. So the remaining 1 or 2 problems, I will consider the other ICA material. With that, we can successfully close the chapter amalgamation. Then we can able to start internal reconstruction. So meanwhile, please have a look about the overall content. Still, if you are facing any doubts or any problems, so you can ask me at any point of time in tomorrow's session. And in tomorrow's session, if time possible, I'll try to conduct a question answer session, something like that for 5 minutes. So then you can able to raise your voice there. Okay. Bye guys. Have a nice day.